All right, we've been talking about the required rate of return, and we talked about the risk-free rate, and we talked about the inflation premium. Now let's talk about the risk premium. The risk premium. So three components to the required rate of return: the risk-free rate, the inflation premium, and the risk premium. When the amount and the timing of future cash flows, which these cash flows are interest, dividends, and or capital gains, are uncertain, investors require added compensation or return in order to make an investment. Okay? And this added return above and beyond the risk-free rate and the inflation premium is called the risk premium. And this component of the required rate of return is unique to each individual security and to each investor. So every investor has his or her own perception of risk and requirement of return in order to take that risk. And every security has its own level of risk. Okay? The risk premium reflects investor sentiment or investor mood. If investors are optimistic, so it's behavioral, if investors are optimistic, the risk premium is relatively small or low. What does this mean? This means investors believe there is less risk. Okay, they see less risk out there if they're optimistic. When the risk premium is relatively low, the required rate of return is also relatively low. If you don't see a lot of risk, you don't require a lot of added return in order to make the investment. Okay, so your required rate of return is lower. If the required rate of return is relatively low, then asset prices are relatively high. If the discount rate is low, then the multiple and the price is high. That's how it works. Okay, so when people are optimistic, multiples are high, the discount rate is low, and the prices are higher. Okay. When investors are scared, however, the risk premium is relatively high. Okay? This means investors see more risk. Okay? So on a daily basis, when the market moves, sometimes it moves because of news that affects the forecast for cash flow, good or bad. Sometimes the news will affect the discount rate or the multiple, good or bad. And what we're looking at right now is the discount rate or the multiple, the required rate of return. We're not looking at cash flows. Okay? All right, so when the risk premium is relatively high, the required rate of return is relatively high. And a relatively high required rate of return means that stock prices are relatively low. The discount rate goes up, present value and multiples go down. That's the way the math works. Okay? Remember, the value of an asset is the present value of expected future cash flows. Therefore, to derive a fair value for an asset, an investor must forecast future cash flows and forecast a fair required rate of return, the discount rate, or the reciprocal of the discount rate, the multiple. Okay? So when multiples are high, that means that people are optimistic and or people are expecting the growth rate of cash flows to accelerate. When the market is low, that means multiples are low. That means people are concerned about rising interest rates and they are concerned about decelerating cash flow growth. Okay? So you need to understand that. All right. The distribution of forecasted cash flows is usually pretty tight. In other words, analysts are pretty good about the forecasting cash flows. They're usually not too far off. Okay? So it is not often that the actual cash flows that are forecast are that the actual cash flows are materially different from the forecasts of those cash flows. Therefore, it is fluctuations in the risk premium which is investor sentiment or multiples. Okay? Investor sentiment, human behavior, is more volatile than changes in cash flows. and that greatly explains fluctuations in asset prices. So stock prices go up and down more because of changes in investor mood than they do because of changes in the fundamental value of the companies themselves. The value of the companies really doesn't change that much day to day or week to week or month to month or quarter to quarter. The value, the intrinsic value, the real worth, really doesn't change much. But investor mood certainly does, and that causes multiples to move and stock prices to move. Okay, so what are the sources of risk or uncertainty that affect the risk premium? We're going to look at 5 items. We'll do 4 on these slides, and then the 5th one will be in the next slide, next couple of slides. So, business risk. Business risk. This is uncertainty regarding future cash flows due to the nature of the business. What kind of business are we looking at? Is it a cyclical business that moves with the economy, up when the economy's up, down when the economy's down? Or is it a stable business that grows at a steady rate regardless of what's going on in the economy? Is it an emerging company, a new company, or is it a mature company that's been around for a while? This causes business risk. It's part of the risk premium. Is it a high fixed cost business where you have a lot of equipment in there, a lot of property, plant, and equipment? Think about a steel mill. Think about automobile manufacturing. Think about an airline. Lots of equipment, lots of money stuck in that equipment. Versus a software company that has virtually no equipment, but a lot of humans working there. Okay? So that's variable cost versus fixed cost. Then we have financial risk. Financial risk. This is uncertainty regarding future cash flows due to the method used to capitalize the company. If a company uses 100% common stock, there is no financial risk, so to speak. The investors put their money in, and there is no legal obligation for the company to pay a dividend. That's not a legal obligation until the board meets and declares the dividend. And if the company's not making enough money, the board will not declare a dividend, and nobody gets in trouble. Okay? However, the more debt a company has, the more uncertain cash flows are to common shareholders. Okay? Because of the legal obligations to make fixed payment. Principal and interest are legal obligations associated with debt. Whether the company's doing well or not, they've got to be paid, and this creates uncertainty. All right, then we have liquidity risk. What is liquidity risk? This is uncertainty of future cash flows due to the ability of a shareholder to quickly sell an investment and receive a fair and certain known price for it. Okay? So, to have liquidity, you have to have lots of buyers and sellers involved, and you have to have an organized market. So let me present 2 extremes. Treasury bills. Treasury bills are involved in the most liquid market, just about the most liquid market there is. There are millions of people around the world that trade treasury bills over the counter and on the exchanges. I guess it's just over the counter for treasury bills. But the point is, there's a really good market with lots of buyers and sellers. You know what the prices are, and you can sell a treasury bill or buy one just like that at a price that you know. But real estate, very disorganized market, very illiquid, not as many buyers and sellers, and it could take you 1 year, 2 years, 3 years, 4 years to sell a certain piece of real estate. Okay, so not a good market. All right, and then we have, so that's liquidity risk. Now we have exchange rate risk. Okay, this is uncertainty of future cash flows due to volatility in exchange rates. If a U.S. investor owns a foreign security that is not denominated in dollars, he or she will incur this risk because you must, if you want to buy a foreign security, you have to take your dollars, you have to convert them into the foreign security in order to buy, into the foreign currency to buy that foreign security. Then you watch that security, and then you have to sell it. You sell it and you receive that foreign currency, and then you have to convert that foreign currency back into U.S. dollars. That creates a risk because the stock price could go one way, but the currency value could go the other way and offset it. Okay? So here we go. That's the end of this clip, and we'll plug it in and we'll move on to the next source of risk, the fifth source of risk premium, which is country risk. Oh, here we have another example. So we'll blend this in. Thank you. Peace out. Shalom.